Hello everyone, and welcome. I'm thrilled to have you join me on this journey into the fascinating world of financial statements. Whether you're preparing for the CMA USA exam, aiming to boost your career in finance, or simply curious about how businesses communicate their results, you're in exactly the right place. Today, we're diving into general-purpose financial statements, the essential report card for any company, big or small. These documents are the universal language of business, used by companies all over the world to share their story. These statements reveal a business's performance, financial health, and cash flow. They help us understand how well a company is doing, where it stands financially, and how money moves in and out of the business. My goal is to make these concepts simple, practical, and even a bit fun, just like we do at Khan Academy. No jargon, no confusion, just clear explanations and real-world examples. This topic is a cornerstone of the CMA exam's financial planning, performance, and analytics section. If you master this, you'll have a strong foundation for the rest of your studies. Mastering it gives you the power to read numbers and see the story behind them: success, struggle, opportunity, and risk. You'll be able to spot trends, identify red flags, and make informed decisions. We'll break down the four main statements: the income statement, balance sheet, statement of cash flows, and statement of changes in equity. Each one has a unique role in painting the full financial picture. By the end, you'll see these not as daunting documents but as powerful tools for smart decision-making. You'll gain the confidence to interpret them and use them in real business scenarios. We'll focus on what each statement shows, why it matters, and how they connect to each other. Understanding these connections is key to seeing the bigger picture. Think of yourself as a detective. Each statement is a clue, and together they help you solve the mystery of a company's financial health. The income statement covers a period, showing how much was earned and spent over time. The balance sheet is a snapshot in time, revealing what a company owns and owes at a specific moment. The cash flow statement tracks the movement of cash, the company's lifeblood. It shows whether a business is generating enough cash to sustain itself and grow. Together, these statements provide a complete, interconnected financial picture. They're like puzzle pieces that, when put together, reveal the whole story. We'll explore each statement in detail, highlight key elements, and offer practical CMA exam tips to help you succeed. Our goal is to build your confidence so you're ready for any financial reporting question, whether in the exam room or the boardroom. So let's get started and unlock the world of financial statements together. Get ready to become fluent in the language of business. What are general-purpose financial statements? They're standardized reports designed to meet the needs of a wide range of users: investors, banks, managers, and more. Instead of separate reports for each user, companies prepare one set everyone can understand. There are four main types: the income statement, balance sheet, statement of cash flows, and statement of changes in equity. These statements provide a comprehensive view of a company's financial health. They're prepared according to rules, GAAP in the US, IFRS internationally, to ensure consistency and comparability. Without these standards, comparing companies would be impossible. The ultimate goal: provide useful information for economic decisions. Investors, lenders, and managers all rely on these statements to assess performance and make smart choices. They're the foundation of sound financial analysis and business decisions. Let's start with the income statement, one of the most important financial documents for any business, large or small. It's also called the profit and loss statement, or simply the P&L. This document is a financial storyteller, summarizing how a company performed over a set period, usually a quarter or a year. Its main job is to show how profitable a company was during that time. It answers the big question: did the business make money or lose it? The story begins at the top with total sales, also known as revenue. From there, you subtract all the costs and expenses the company faced to arrive at net income or loss, what's often called the bottom line. The structure is straightforward. Revenue sits at the top, and when you subtract the cost of goods sold, COGS, you get gross profit. This shows how much money is left after covering the direct costs of making products or delivering services. Next, you subtract operating expenses, things like salaries, rent, utilities, and marketing. What's left is operating income, which reflects the profit from core business activities. After accounting for non-operating items such as interest and taxes, you finally reach net income. This is the company's true profit or loss for the period. The multi-step format breaks down each stage, letting analysts and managers see profitability at every level, from gross profit to operating income to net income. For investors, the income statement reveals a company's ability to generate profit, a key sign of efficiency and long-term potential. Managers use it to spot trends, identify strengths and weaknesses, and make better decisions to improve future performance. For the CMA exam, it's crucial to know both single-step and multi-step formats and understand when each is used. You'll also need to calculate key metrics like gross profit margin and operating margin, which measure profitability at different stages. These metrics help you analyze how well a company turns sales into profit, and they're common topics on the exam and in real-world analysis. Understanding the income statement story is your first step to financial mastery. It's the foundation for analyzing any business's financial health. Now that you know how to read the income statement, let's move on to the next financial statement and continue your journey. Next is the balance sheet, a snapshot of a company's financial position at a specific moment. It shows what the company owns, assets, owes, liabilities, and the owner's stake, equity. The core equation assets equals sign liabilities plus equity. Assets are resources with future value. Liabilities are obligations. Equity is what's left for owners. Assets and liabilities are split into current, short-term, and non-current, long-term categories. This helps users assess liquidity. Can the company meet short-term obligations? For the CMA exam, know how to classify accounts and calculate key ratios like current ratio and debt-to-equity ratio. These ratios reveal solvency and financial risk. The balance sheet is essential for understanding a company's structure and stability. Let's see how cash fits into the picture. Now, let's talk about the statement of cash flows. This financial statement is often overlooked, but it's one of the most important tools for understanding a company's true financial health. While the income statement and balance sheet show profitability and assets, the statement of cash flows tells you how money actually moves in and out of the business. A company can be profitable on paper, but still struggle to pay its bills if it doesn't have enough cash on hand. Cash is the lifeblood of any business, and running out of it can lead to serious problems, even bankruptcy. The statement of cash flows tracks all cash inflows and outflows during a specific period, reconciling the beginning and ending cash balances. It helps you see exactly where cash is coming from and where it's going. It's divided into three main sections: operating, investing, and financing activities, each providing unique insights into a company's financial operations. Operating activities show cash generated or used by the core business, like cash received from customers and cash paid to suppliers and employees. This section reflects the day-to-day running of the business. Investing activities cover buying or selling long-term assets such as property, equipment, or investments in other companies. These transactions can signal growth or downsizing. Financing activities include transactions with owners and creditors like issuing stock, borrowing money, or repaying loans. These activities affect the company's capital structure. For the CMA exam, you'll need to classify transactions correctly and understand both the direct and indirect methods for preparing the operating section of the statement. The indirect method, which is the most commonly used, starts with net income and adjusts for non-cash items like depreciation and changes in working capital. The statement of cash flows reveals whether a company can sustain its operations, meet its obligations, and invest in future growth. It's a window into the company's financial flexibility. It's a vital tool for managers and investors alike, helping them make informed decisions and assess the company's financial strength. Next, let's look at how ownership value changes and what that means for stakeholders. The statement of changes in equity, or statement of retained earnings, tracks how owners' equity changes over a period. It starts with the opening equity balance, adds net income and new investments, and subtracts dividends and losses. The result is the ending equity balance, which matches the balance sheet. This statement links the income statement and balance sheet, showing how profits are reinvested or distributed. For the CMA exam, know how to calculate ending retained earnings. Beginning balance plus net income dividends. It's crucial for shareholders to see how their investment's value has changed. This statement answers how much profit was reinvested and how much was paid out. Now let's talk about the details behind the numbers. The notes to the financial statements are essential. They provide context and detail behind the numbers. Notes explain accounting policies like depreciation or inventory methods, which affect comparability. They break down summary figures such as property, plant and equipment, and detail long-term debt. Notes also disclose important non-numeric information, lawsuits, commitments, or contingencies. Ignoring the notes is like reading only headlines. You miss the full story. For the CMA exam, understand what information is found in the notes and how it impacts analysis. The notes are examinable and critical for a complete financial picture. Always read them for deeper insight. Why do so many people care about financial statements? Because different users rely on them for crucial decisions. Investors assess profitability and growth potential. Income statement and cash flows are key. Creditors and lenders check solvency and cash flow to judge creditworthiness. Managers use statements for planning, control, and decision-making. Government agencies and regulators ensure compliance and fair markets. Each group looks for answers to their own questions, but all depend on accurate, standardized statements. These reports are the foundation of corporate accountability. That's why mastering them matters. Let's wrap up with practical tips for CMA exam success. Know the formats. Picture the structure of each statement and where accounts belong. Use templates or flashcards for practice. Master calculations: gross profit, operating income, retained earnings, and cash flow from operations. Practice financial ratios and work through lots of problems to build speed and confidence. Focus on how the statements connect. Net income flows into equity, equity appears on the balance sheet, and cash flows reconcile cash balances. Draw diagrams to visualize these links. Don't just memorize, understand the story behind the numbers. Ask, is the company growing, profitable, managing cash well? This analytical approach will help you on the exam and in your career. The CMA is about becoming a strategic business partner. Financial statement mastery is your most important tool. Keep studying, stay curious, and you'll succeed.